Okay, so I've titled this training The Busy Investor's Guide to Building a Market Beating Portfolio. And the reason is because with all the things going around us in this world, you know, every day seems like it's filled with so many things to do. We never have enough time. And because time is one of the most expensive resources that we will ever have, you can never make time and you can never get back time that you've lost, right? So, how do you make the most of your time to get the best market beating portfolio? But before I start, let me just go through this quick disclaimer. So old school value, if you haven't noticed, is a financial investment software site. We're not a broker, dealer, or a registered investment advisor. It's a do-it-yourself platform where we provide the tools and try to provide as much information and insight based on statistical research and value investing analysis. So please make sure to do your own research. Due diligence is very important, and nothing in this training should be construed as investment advice. So if you're a passive investor or if you're an active investor, this training is going to be for you. If you want a shortcut to eliminate the time, because there's a lot of things that you have to do in your investment process, and you want to be able to focus on selecting better stocks and not having to go through all that tedious and laborious work to find what you're looking for, then this is exactly for you. On the other hand, if you're after a get rich quick scheme, or if you want to put in zero effort, you want zero risk, and you don't believe in value investing, then this is going to be a pretty hard. This is going to be pretty hard. It's not going to be the ideal training for you. Okay, so my philosophy is, and with old school value, it's not a get rich quick scheme, and it never is. And at the same time, as much as I love doing all the hard work, I love reading and looking up documents. I understand that for the most part, for the most people, it's not about that. I don't want people and you shouldn't expect to devote 100 hours of your time to become an investment professional, the next Warren Buffett. And at the same time, also don't want people falling prey to bad financial advice or listening to hot tips and getting burned that way. And I want to help you reduce your learning curve, get the most out of what time you're putting into the markets, and then enjoy the process as well, because it's all about building long-term wealth. And for example, if somebody came up to me and asked me what I held in my portfolio, I want to be able to quickly explain in like an elevator pitch exactly what I'm holding, why I'm holding, instead of looking dumbfounded, because nobody wants that, right? My first investment was in variable life insurance. Yep, it was an investment. Exactly. After a few months, I realized what a bad mistake it was when I saw all the premiums that I was paying fall into other people's pockets as fees and high commissions. So I canceled the contract and I basically forfeited $3,000. And this was a pretty big amount for me because I was just pretty much out of college. I'd moved to the US on my own and I was starting a new job. And while I was down and on myself about this, like most people, they come across the intelligent investor. I happened to come across this because my wife or girlfriend at the time had this book in her home. And just by looking at the cover, I definitely wanted to be an intelligent investor. But this is what happened. I I couldn't make it through. I literally slept and fell asleep every time I read the book because it was dry, it was boring, and I had no idea what it was talking about. It literally took me 10 tries to get through the book, and I still didn't really understand. But I kept at it. I knew that I wanted to be in control of my finances and make the best out of it. I was also working full time, like most of you guys. And I wanted whatever investment money I had to do well. So I made all the common mistakes. I kept working on my process to improve as an investor. And I also really love to share what I'm learning. So that's why I created the blog. I started writing, created tools that I was making to keep myself organized and to put into practice what I was learning. So that's how old school value was founded in 2008. I'm a former test engineer. I call myself a 3-in-1 geek because I'm a value geek, I'm a data geek, and I'm an optimization geek. I'm also, most importantly, a private investor. So I invest my own portfolio, my family's portfolio, and I'm definitely eating a huge portion of what I'm cooking, of what I'm saying when it comes to investing. Hopefully, by the end, this is what you'll be able to take away. You'll have a better understanding of how to find better stocks quickly than you normally do. Find either utilize old school value systematic system, or you can utilize your own, come up with your own process. Be able to quickly identify, understand stocks, and I'll be covering some strategies that a lot of the questions that I've had over the years for passive and active investors. So let's quickly identify one of the major problems we face. Okay, the theoretical way of buying a stock is like what you see here. But let's be honest, right? How many people actually do it? Even people in the investment world can't follow this routine. And that's because it's overwhelming and it doesn't fit in well with how we go about finding and analyzing stocks. Or, in other words, it's not a natural flow. It's certainly not flexible enough to adapt to a real world approach for the everyday investor, or even for a smaller fund investor who's like so overloaded with um, office work, taking care of clients, and extra other activities. The way I do it, I just break it down into four much broader steps. Basically, you find ideas, you make a short list of candidates, you make a high level valuation and check, and then you go searching for answers so that you can buy and sell with confidence. An easier way to think about these steps, these are the questions that I like to ask. So, what stock should I buy? Is it worth spending time on? What's the ballpark value of a stock? And then I take the next step as to whether I want to buy or sell. But here's the actual process for the majority of investors, especially with the being so busy and the limit of how much time we can spend. We spend most of our time just window shopping for stocks. We read about something or hear about something, and we think that it's a pretty good idea. So we go from step one, what stock should I buy, to immediately buying. So I want to take you through these four broad steps quickly. Um, and we're going to start with fish with a fisher. So I use this fishing analogy because it's very much the same. When you go fishing, you don't go out to the ocean and expect to catch something as soon as you throw it down into the water, right? You have to go with a fisher. You have to find that really good fishing spot. And the way we do that is by using a QVG process. And based on your personality, you tend to gravitate towards one of these. On the quality side, you hear or read about defensive stocks, maybe it's a dividend stock, but the goal is to play it safe, limit downside, and move along with the market. On the value side, we know value investing works. Mike asked, why does value investing works? But it works because it's a fundamental process. We're looking for cheap stocks, we're looking for misunderstood stocks, and we're not overpaying. And the focus with value players is to limit the downside, right? And growth is what the market likes. And regardless of how bad the fundamentals are, if a story is mesmerizing, it can keep leading the market. But at the same time, it tends to have the biggest drawdowns if the market falls. So personally speaking, I leaned heavily to the value side because I just wanted everything for cheap. But what I've really trained myself and come to learn over the years is that you can have value, growth, and quality in the markets. It's not just one or the other. You can have all three because the stock market offers that opportunity. Warren Buffett says it's a no called strike baseball game. You don't have to swing at everything. You just have to go for the best, fattest pitches. And that's what we're doing with this QVG process. So if you think value and quality it's going to be hard to find, you can have that. If you are seeking value and growth, you can have that. And so this is a paper A report that I came across. It's done by Professor Robert Novi-Marx, and he's done some excellent work. And so he's showing you the performance of a portfolio when you combine value and quality. He's comparing it to just regular traditional treasury bills, magic formula, just regular value only. And there's a whole definition of what he defines as value. But you look at this and you can see that when you combine value and quality and these two factors, it really does outperform the market because you're not just looking for one specific area. Even Warren Buffett says that growth and value joined at the hip, right? We tend to separate it, but in reality, you can't really separate the two. You should always be looking for something that has both components together. And the way I do it is, and the way you've probably seen is through my action score. I'll go through this a bit later, but basically, it's a quick way for me to look at what the stock is, get an idea of whether I want to quickly look into it or not. So when I built the action scores, I really had to just slow things down and get back to what I was really looking for in a stock. So before I created Old School Value or the online app and then the action score, I was all over the place. I on my shelf right now, I have so many books, very technical, very deep books telling you why you should use this strategy, you should do this, and they're all different. So with all that information, how do you really condense it? How do you know what you want to do? And so I was getting overwhelmed with information. I was getting overwhelmed with my process, and I was making bad decisions, thinking that I was a great stock picker because I was following these examples. But but because of all that overloading in information, I was making bad judgments and plenty of bad errors. And so it came down to defining exactly what I want in a stock. Somebody asked a little bit earlier, okay, do I use free cash flow? And yes, definitely. I've done plenty of testing on free cash flow and have seen and read papers that it's a very good indicator for a strong performing company. But if I quickly go through this list, I have the Piotrowski score as a junk filter. So when I'm looking at 6,000 stocks, there's no way I'm going to make a good judgment on 6,000. So just like you have a junk filter in your email to filter out all the crap that comes in, I use the Piotrowski score to do exactly that for me. So my 6,000 automatically gets shrunk down to, say, a couple of thousand. And then I apply my optimal ranges for cash return on invested capital, free cash flow to sales, price to free cash flow, and these other ones to really narrow it down to the best scores. And based on what I'm using so far, you can use it as a mechanical approach, and the strategy is simple. Buy at least 20 stocks at the start of the year, make it equal weighted, and then rebalance at the end of the year. And I'll show you a really good quote and information of why you should do it like this. But basically, this is how I did my back test over a 17-year period. You can see the amazing results. And yes, keep in mind that these are theoretical results. It doesn't factor in commissions, trading fees, taxes, slippage, and other factors that go on in real life. So what I say is when you look at these theoretical returns, you should expect it's going to be about 10%, at least 7 to 10% lower in real life, depending on how you go about selecting stocks, which broker you use. Maybe you have like a $10 commission fee, etc. People tend to think that you have to be a really sophisticated investor in order to do well in the markets. I have a member, and I've talked to many people who say they feel like cheating when they just use a very simple approach because they've been doing good and they're not spending like 100-hour weeks trying to rip apart an analysis or a company. And back in 2014, so I want to show you this study. If you know AAII, so American Associate of Individual Investors, they have all these screens available. And what Alpha Architect did was they tested to see whether these screens were actually profitable compared to a very single metric, simple basic value screen. So EBITDA divided by total enterprise value. And the result is that of all the screens, except for the Piotrowski F-score, which is again why I use it because it's proven, the simple one metric screen, the EBITDA to enterprise value, outperformed all of them at a compounded average growth rate of 16.52%. And that's not bad considering all the different factors and all the different metrics and requirements that go into each of these screens. So investing doesn't have to be complex. He says that simple value investing, it works, if not better than more complex value investing models. You have to be able to filter down your universe. Okay, I have used the Piotrowski score, and I know many of you do as well. But you can also extend that or replace it with something else. You could use like the Graham checklist, where Benjamin Graham has listed 7 criteria that he uses. You can also use the Altman Z to eliminate companies that are looking like it's going to go bankrupt. The Benesch M score eliminates, or you'll be able to find companies that are pretty high on the list for earnings manipulation. I also really love gross profit to assets. The magic formula, the ROIC, you can use that version as well as a Sloan accrual. Again, when I share these slides, you can click on this link, and this will also provide, thankfully, a lot of the information that I've included here. It's a really good paper written again by Professor Novi Marks. So once you've identified what junk filter you want to use, then it's time to really understand what your quality criteria is. Make sure you don't overload it. You don't want 5, 6, 7, because in the end, you'll never come across a company that is going to meet it. And even if a company does meet all that criteria, it doesn't guarantee that it's going to be a successful investment. Great companies are not always great investments. And so you want to be able to still keep your options open by keeping it to a maximum of 3 stocks. I mean, not 3 stocks, 3 criteria. So you could do something like, if you're a dividend investor, looking at dividends, payout ratios. If you really into company management, do ROIC, or cash return on investment capital, CROIC. Look for 10 years of performance, historical performance. Or maybe if you just don't want that volatility, you could have a quality metric saying, I want less volatility, I want smaller drawdowns, and think about what you need. And because there are just so many different possible combinations, these are some ideas to help you get started. On the value side, these are some of the metrics that you can look at. Again, remember, I really like price to free cash flow. I also really like free cash flow to sales, because that shows you how much free cash flow is converted from sales. So if I make $1 in sales and I have a 16% free cash flow to sales ratio, then that means 16 cents of every dollar in sales is becoming free cash flow. And that is an amazing cash generating company. On the growth side, now this is more difficult, because when I talk about growth, I talk about growth in a different way. I don't talk about growth in like always earnings growth or stock price growth, like what most traders and what the people on the CNBC will talk about. When I look at growth, I use gross profit to assets. And I'm talking growth in terms of, is the company growing in efficiency? Is the company growing in profitability? Is the company growing in quality? So that's the type of growth that I go after. So I'll look for things like owner earnings growth or efficiency growth. I mentioned here lower cash conversion cycle. Is the company able to, are they improving the speed at which they are converting their assets into cash? Things like that. You can actually use or find a lot of the metrics that I talk about within the app. So let me just bring that up. So with the metrics that I'm talking about, if you go into old school value, I've got the if you go into key stats, key ratios, you can see the historical performances, and you can see like the 5-year minimum, the median, and the maximum, and then see from a really quick glance how your company is doing. So if you have a specific criteria that you're really interested in, like I said, free cash flow, and I'm looking at, say, Apple at the moment, price to free cash flow, it's gone down because obviously the market hasn't been loving them as much, so the stock price is down. But you can see the trend, and you'll be able to really get a quick idea of what type of company it is and what you're really looking at. So these are the ways that you want to be able to quickly eliminate all the hard work, all the labor intensive work of manually typing data in, looking up SEC documents, and doing all the tasks that aren't really generating you much profit in terms of your time and ROI and your portfolio. Okay, so once you've come up with your whole idea, you've come up with your criteria. Let's call it your action score. You have to just be able to decide whether it's a company that you want to look at or you want to pass up. Even if you use your criteria, expect about a couple of hundred stocks. So how do you go through that list quickly? But first, let me ask you a quick question. Okay, this is going to be easy. Just think of the answer in your mind. How many animals of each kind did Moses take on the ark? So if you're like me, you would have answered two. But in reality, the question that I asked is, how many animals did Moses take on the ark? And Moses didn't take any. It was Noah, right? Which brings us to the fact that a small mistake and a small incorrect mistake in our judgment causes major problems and setbacks as an investor. I used to only hold like 4 to 5 stocks in my portfolio, and I used to be really concentrated. I strongly believe that Warren Buffett knows what he's talking about, but at the same time, he's talking about it from his point of view. He has a different background to all of us. And so I've made some pretty big mistakes when I had a 10% portfolio go down on me 20%. That's not a good feeling that you want to wake up to. And so I've come to the conclusion and realization that no matter how much work I do, I'm going to make mistakes, especially because I have my own biases. And that's why I created the action score. It's a shortcut, to an objective way to filter out these stocks. Just like if you answer two for each animal, instinctively, well, in reality, you know what the answer, but instinctively you say something else. That's why a lot of people, they hold on to losing stocks. They hold on to hope, and just pray that the stock will recover instead of being really emotional about the whole buying and selling process. So this is why when I created my version of the action score, I focused on higher grade stocks. So based on some historical testing. So this is a report that a member did for me. Before he signed it, he was like, "Hey Jay, you know what? I want to make sure that what you say is actually true. Can you share the data with me, and so that I can run my own test?" Because he comes from a statistical background. So I was like, "Okay, yeah, go ahead, go for it." And what he saw is that each graph represents 20 stocks, a basket of 20 stocks, and he took it from the lowest scoring stocks all the way up to the highest. And the blue line represents the trend going up. This is a different stock picking simulation. Each year again represents 1 year, and each chart has 1,000 simulations where it randomly chooses 20 A grade stocks. So just 20 stocks in the A grade universe, it randomly chose 20. And then these are distributions of return. When there were less than 20 A grade stocks, like in 2007, 14, and 15, you don't see the charts because it would only just be one combination. But the red line represents the stock market return, and the blue and the blue, yeah, the blue represents the average return. And so for really most of the years, you'll see that having a really qualified and identified process of what criteria you're looking at does outperform the market. Another look at it is this number 2 simulation. So yeah, you could do it for every single year, but what you can also do is what he's done is he randomly selected 20 stocks for a single year to simulate what a real investor would do. So the simulation randomly chose 1 year out of the years from 1999 to 2015, and then it randomly selected 20 stocks and did it 5,000 times. And so you see the distribution of returns here. And if you ask me, would I take this bet saying, you have a 6 to 4 chance that you'll make money, I would flip that coin every single time. And it all comes back to identifying what stocks you're looking at. So if I'm looking for big fat tuners, I'm going to be playing in the really rich, best fishing spots. I don't want slugs. I don't want weird creatures. I don't want to be catching or wasting time in that area, right? So when you come across a stock with all A's, I call it the trifecta stock. It's at the top of it's at the pinnacle. And I created some screens to show the stocks that come up. So if I go to screener, so in the trifecta stocks, these are some preset filters that I have. You'll notice that all of these stocks are triple A's, and there's not that many because it's a very strict requirement. But of these, these are the best of the breed. Okay, so you can look at this. The next set of companies is the B grade. So if you have the A grade, but the universe of A stocks isn't always going to be as big as a B grade. But at the same time, these B grade stocks also have really good potential. It doesn't mean that A stocks are always better. B grades are just as good because a B can turn into an A. And I've classified them into three. So you can have Q and a V, so quality value. You can have Q and a G. You can have V and a G, quality and value. And so I've called this a sleeper stock. If it's a Q and a V, a company that exhibits quality and growth, I call it a Munger stock because Charles Munger, that's what it reminded me of. And value and growth, this is sort of hidden, but it represents a GARP stock, growth at a reasonable price. When it comes to a C and a D, now this is where a lot of investors, these are the playing grounds that a lot of investors play in because you're either leaning towards one or the other. So you want, when you're looking at just a quality stock or value or growth stock, these are the type of stocks that come up. And these, again, borderline on the negative side because they could easily turn into really horrible companies. I say if it's just a quality only stock, then I call it a mom and pop because, yeah, they're good companies, but nobody's going to really pay up for these companies. There's not much growth. If you're just looking for value, just cheap stocks only, then I call it the value stock. Yeah, just being cheap is a really good way to profit in the market. But you can also lose a lot of money if you don't put in the required effort to overturn those stones. So keep in mind that when I'm talking about this, I'm talking from two angles, one for the passive investor, one for the active investor. If you're an active investor, you definitely want to look into, for example, if you come across a D grade stock, I'm going to go into a value trap stock. So if I look at it and I come across, let's see, here's something like a D. So Janelle Corp, or it's an OTC, so I'll skip that. Let's do, here's something like BOFI Holding. I have no idea what BOFI Holding is, but it has a great value metric, okay? And let me click on it. It looks like it's pretty undervalued. But then what the actual action score is telling me is that in terms of free cash flow, it has it's 66.8. So that's unrealistically high. How long can it keep that up? On the value side, it has some pretty good growth. I mean, pretty good value. So that's understandable. But then let's look at the growth. The growth is very high. Okay. So how do you believe that 40% growth is sustainable? It's scoring an F because it doesn't have a gross profit to assets, so it's likely a financial something. And the pure Trotsky isn't the best as well. So in this case, if I was looking at BOFI, where was it here? BOFI, I would be asking myself, okay, so I looked at the quality. It's got a really high free cash flow to sales ratio. Is that going to be sustainable? And is that quality score going to go up and become a Q and a V stock, essentially becoming a sleeper stock that the market doesn't really know about? Or is that quality going to stay bad or get lower? Same with the growth. So those are the two areas that there's two ways that a stock can go, either up or down, good or bad. And I'll have the flow chart for that a bit later. But this is why you need to put in that extra effort, especially if you're going to be doing your own analysis. Okay, so if it's a C grade stock, for example, I get a lot of questions about Amazon. Let's see. So Amazon, I've already loaded up Amazon. So this is where you see Amazon. The reason why Amazon scores a C is because on the value side, the F just hammers it down. So this is the F where you you look at these value metrics, and it doesn't really make a lot of sense fundamentally. So, but then again, remember I said that just because a company has one bad or the other, it doesn't necessarily mean that you should write it off. It's a C company, but it has quality and growth. And for Amazon, you could, if you know the story and you've done the work, then it's definitely going to be an okay buyer. Granted, it comes down a bit. Same with Nvidia. The stock price has just shot up over the past year, and you have to think about, okay, is the right now this quality is scoring pretty high, the value is low, the growth is okay, it's borderline on a B, but how will this transition? So think about that. On the D side, so these are some D examples. I showed that this company, Dr. Reddy's Laboratories, it has the characteristics of a Q and a G. Okay, so it's got a quality score, it's got a growth score. And when you look at the default free cash DCF based on the default inputs, it's showing that it's really undervalued. But if let me quickly go in again, look up RDY. I'm going to look up RDY. I'm going to go into the valuation side. And the current price right now, or this is, let's see. Okay, so yeah. So I go to the DCF, and the default input is EPS. But if I change this to free cash flow, look how the value changes, because the growth rate is coming in at 41%. It's a median of the growth rate that we use for analyst estimates, the historical growth rate of how it's done in the past, as well as some long-term future growth estimates. And right now, the average or the median is coming out at 41%. And so if I lower this down to, let's say I change it to free cash flow, and I lower this down to, let's say the reverse free cash flow is actually showing me that based on the current market price, it should really be a growth rate of really 9% is baked in, right? But let's say if I was optimistic and I did my research and I thought 20% was going to be high, 20% was going to be a good rate, and then I looked at it, then it becomes much more manageable than 41%. So based on this, I could, on my further research of looking into value, I could say, okay, so the value says it's an F, but then when I run my own analysis, I see that it shouldn't be an F. It should probably be like a C or a D. So it's not as bad as it seems. So in this case, Dr. Reddy's has more potential to go on the upside as opposed to staying a D and falling to an F. And same with T. Rowe Price. This has much better value chart, DCF, and valuation chart. But it all comes down to, you have to go in and make the assumptions. You have to be able to know the story. You have to understand the company to make the proper assumptions to really decide whether you want to give it some extra marks in any certain areas. When you do look at an F grade, you have to keep in mind that just because it has bad fundamentals, it doesn't mean it's an F. The thing with algorithms and creating an automated process is that it condenses the entire universe down to a manageable size. But at the same time, there's a lot of companies that fall off, like cyclicals, financials, OTCs. And the reasons why these could become an F is because of the metrics that I'm using. I have optimal ranges, and there are sectors that are never going to fall into that area. For example, oil and gas is going to be really difficult because they're so capital intensive. OTC stocks, especially the nano caps where they don't really file properly, or the numbers they don't match up as well, they could have issues. If there's a complicated financial, then it's a complicated company. Like I currently hold U-Haul, Merco, and their balance sheet and their financial statements, it's not something that a screen will pick up. So if that's the case, it's going to be rated a low score because there's a lot of value hidden outside of the balance sheet, or it's in brands or other areas that aren't going to be representative in the fundamentals. So remember that a stock has multiple ways of going transitioning. If it has an all A, somebody asked, okay, and I'll get to this. If it has all A's, it doesn't mean that it's going to be the perfect stock. There's no such thing as a perfect stock. Even if it has an A, it's showing great characteristics, but it can transition towards either a B. An A can't go up to any higher. It's going to change to like a B or a C, or hopefully not an F. But for the most part, I've seen a lot of A's go down to a B because as the stock price rose, or as they had one bad quarterly report, something like the value or the growth or the quality will go down and they become a B. But then over time throughout the year, they return back into an A. And that's what happened with Hawaiian Air Holdings. And let me quickly bring that up. So Hawaiian Holdings, they reported earnings yesterday, and the stock dropped about 5-6%, I believe. I haven't checked the stock market today. I don't really check it on a daily basis. But what it did was, okay, so it's got all A's. It's showing that it's got some really great qualities, fundamentals, and it dropped. Just because it's a trifecta, it doesn't mean that it's going to continue to go up. Keep in mind that businesses are constantly changing, their differing opinions about them change. But what the action score is telling you, what my criteria is telling me, and if you build your own, what it will tell you is that you get a single point in time view now, and then it will help you decide whether this company will be able to continue its performance going forward or whether you think it's going to backslide. The reason a lot of people also ask about Hawaiian Air Holdings is look at this chart. Based on the default DCF model, right? If I run a DCF, it shows that it's overvalued. The current price is 51 something. The median is going to be like 40 based on different types of valuation metrics. But thing with valuation is that one variable changes. The current expected growth rate that's currently being used is 5.9%. Before with Dr. Reddy, you saw it at 40%. With Hawaiian Holdings, it's completely the opposite. It's 5.9%. If I change this to say like, I don't know whether it's going to be true or not, but let's say it's 10%, then it tells me that the company is fairly valued. Okay, so it's going to, so you have to think about that. If I go back, let me go back into the ratings. So when I look at this chart, I have the hindsight bias and immediately think, oh no, it's already gone up this much. I don't know whether I should buy. And I take a step back. The question is that the good question that you should be asking? And with the action score, with your own criteria, if you make it, and with what I provide, I use this data. I look at the quality. It has really good free cash flow, 16%. Okay, that's a coincidence, but that's what I was mentioning before. Has fantastic ROIC. It's an airline company, but at the same time, they're extremely well managed. It has a price to free cash flow, which is very reasonable, a very low EV to EBIT. Price to book value is on the higher end. On the growth side, they've been positive. They've been growing in profitability. And so when I look at this today and think, okay, is Hawaiian Airlines a good company? And I block out my hindsight bias of what the stock price has done in the past. If I look at it now and say, if I buy Hawaiian Airlines, Hawaiian Holdings now, is it going to be a good investment? And if I were to ask many people, if I hid the name, if I hid the stock price, gave you just these stats, I'm sure a lot of people would say, yes, what company is that? Sign me up. And that's the process. You want to take an objective, a systematic approach. But I'm not going to put 20, 30% of my portfolio into Hawaiian just because it's an A grade. I'm going to be methodical. I'm going to put in the correct asset allocation. So these are the flaws that you need to think about. If it's a B grade, it can easily turn into a and a C. When it's a C grade, remember, these are the borderline negative stocks. It has to really perform on the, like for a manga stock, it has to really, okay, sorry, I made a mistake on that. It should be a mom and pop. It has to really perform well on the value and the growth. Likewise, on the value trap, it has to do better on the quality and the growth. So you have to dig in. You don't want to just skew yourself into whether, like when you look at this quality, value, growth, you don't want to always just stick to one area, because look up the portfolios of the best investors and they're going to be in a subset. They're going to be either in between or in the middle. So here's some rules of thumb. When you use the action score, you want to stick to the A's and the B's. The C's are okay, but again, some more research is needed, because when you look at the backtest, this is over the entire 1999 to 2015. The blue line represents the average stock return, and you can see that as the action score goes up, the average return goes up with it. So by focusing on the A, B, and the C crowd, you're going to be really fishing in a very secret fishing spot. There's not many people around you. Nobody's spitting in the water. Nobody's peeing inside. You're in a very quiet area, and you can focus on the high quality stuff, and you can ignore the noise. So this is how I get my signal out of all that noise. If it's an A, obviously it's going to be a buy. When you saw the backtest before and it did 1,000 simulations of randomly, or 5,000 simulations of randomly picking 20 stocks, it outperformed the market. And based on all the testing, I'm actually in the process of getting another independent testing report to see whether what all the things that we've been tested is true. But so far, in all the testing that we've done, if it's an A, it's a buy. B, it's a buy and a hold. C is when I hold. D is when I also hold. I don't immediately buy or sell just because it's a D. And if it's an F, I don't bother looking at it. My buy rules are much stricter than my sell rules, in the sense that if I have a B or an A stock that at the time when I bought, but then the stock price ran up and the value score goes down, that doesn't necessarily mean that it's time to sell. So I would hold. So that's why I say that my selling rules are a bit looser than my buying rules. So this is the mechanical approach that you can use. Make sure if you do something like this in your own research or with the action score, you want to buy at least 20 stocks at the start of the year and make it equal weighted. Okay. 20 or a bit more is okay. And then you rebalance at the end of the year. And that's how all these back tests were done over a 17-year period. So for the active investor, like I showed you in the previous screen, use the action score to leverage your groundwork. Instead of having to manually go through like 6,000, 7,000 reports and trying to find a needle in a haystack, what you do is use it to get right off the bat a really good set of companies that you can really dig into. For the passive investor, you want to buy, like I said, 20 stocks and rebalance yearly. And some people have asked me why. And I think I'll let Joel Greenblatt tell you why. Because in all honesty, most people don't put in the required work to run a small portfolio. You need to be diversified. He recommends 20 to 30 magic formula stocks. And he also uses a quantitative approach with his own fund as well. So you let the algorithm do the work, you let the math do the work, and then you can dig in if you're into a bit more active investing and you want to get into the company. All in all, the purpose is to keep it simple, because investing doesn't have to be complicated. Hedge funds, that's what the news tells you. That's what people tell you. They tell you that you're not good enough. Oh, you have to leave it up to the professionals. But hedge funds underperform. They're supposed to be the most sophisticated investors out there, but they can't do better than the market because they eat up so much in fees. Look at Valiant. They've lost so much money in that. And they could have gone out of it so easily. See, the goal of investing is to get your investing from feeling like unorganized, messy, overwhelming, and sometimes lost like this, to a much streamlined example like this, where you're able to quickly understand what you're buying. You're not overwhelmed or overloaded with information. And so you can make quicker and better decisions. What I've found and the benefit that I've really gotten is that it frees up a lot of my time. Before, I used to look at my portfolio constantly, but now I buy it. I know what I have. I'm confident in what the company is going to do. I haven't um, I haven't put myself into or put in like a big position, so I'm protected in that way as well. But most importantly, I know that I've got a systematic process of making money with stocks. And I'm not repeating habits that cause me to lose money, which is what a lot of people fall into. So as we get towards the end of this webinar, this training, I've put together a nice package if the old school value process and the stock grading system is something you want to use to pick stocks in your limited time. If you become, like for this training only, if you become a member on their annual plan, I'm going to throw in an extra month for free. So that's worth $49. Or if you join the 2-year plan, the 2-year membership, I'll throw in 3 months extra for free. And we're actually going to be raising our price. This is our pricing that I've had when we launched last year. And this was supposed to be an early bird pricing, but we just never got around to it. So we're finally taking the step to increase our pricing based on all the value you're getting and all the money you're making. Because ultimately, if you're busy and you value your time greater than $0 an hour, it's going to be so difficult to manually comb through over 6,000 stocks. You can eliminate all that time and energy spent by using tools to do this labor-intensive and tedious work for you. You save so much time and energy. And then with the additional increase in your portfolio performance by using a systematic process, it's going to pay off in no time. So our prices are going to go up on March 1. So keep that in mind. Go to try.oldschoolvalue.com/OSV masterclass. So I'm planning to do more webinars for the members, just really help you get into the system, reduce your learning curve, and really help you, because my ultimate goal is if you win, I win. And also I've got my portfolio, my family's portfolio in this whole system as well. So I'm eating basically all of my cooking too. So let's head to the Q&A. I've already gotten a lot of questions coming, so thank you. So have I tested this live action score? So we have tested the live version 2016. If you go into, let me quickly pull it up. So if you go into our blog, the portfolio beat the market. It's still beating the market in general. Last year, if you look at, so there's two portfolios. There's one with the full universe where it includes OTC, financials, and everything. But I use this more for like a theoretical upper limit. So the upper limit you can expect is like 28% last year when you selected the top 20. But if you take off 10% from the top due to fees, commissions, not being able to buy into like OTC stocks and things like that, that's why I created this second version. Okay, I don't know whether you can see that, but let me zoom in. Okay. So this is the second version also showed in the presentation. So the 2016, you have that. Last year, the theoretical portfolio returned 8.12% compared to 11.96% to the market. So it did underperform overall, though it's still overperforming. And if you look at some real world portfolios, let's see. Okay, here's the real world portfolios. Okay, it returned on the action score 22.21%. On the quality score, it returned 10.86%. On the top 20 value scores, it returned 3.52%. On the growth score, it returned 16.26%. as well as here's another one that a different member, a member also did. So his portfolio returns 16.13%. And okay, and Brendan has been a member with me for a while, and he did 34% in his real portfolio. So again, it goes back to, do you trust the system? Trust the system, trust the process, and you can actually pick some really good stocks. So in our action score database, we have everything from OTC to Berkshire Hathaway, Apple. So it goes from the OTC to it covers the entire universe for the US market. I've in my category in the screen, you have these default screeners. So if I wanted to look up a sleeper stock with a quality and value with the potential to go up to a AAA, then this is what I'll look at. Right now, there's in the broader market, there's a big downturn in retail stocks. That's why you see a lot of retail stocks coming up because they're just getting hammered. One company that I do hold is Lear Corp. So this is a B, but after doing some more research into the company, I wanted a quality and value company, okay, and something that the market may not be onto right at the moment. That's why I call it a sleeper stock, because if the market loves growth, so if the growth score is pretty low, then I'm potentially onto something where if I can get in early or get in at a fair price, then once the market catches on, it's going to go into a trifecta stock, triple A's, and it's going to produce some really good returns. So I look at Leah, and based on the industry it's in, the free cash flow to sales is not the best because it's got auto components, right, for cars. But I look at the value score and it looks pretty good. You compare it with the other comparisons, it has a good score. And then on the growth score as well, there's some potential there because the Piotrowski is scoring a bit low. The gross profit to assets, because it's a capital intensive business, it's on the low side. But if they improve their efficiency, this can go up. And most importantly as well, they're not losing money. So they've been increasing positively. And this is one of the reasons we look into also in like the other areas it does business. And it was a really good story for me. It's a really good fundamentally too. So I could have looked at just the DCF or the valuation and said, okay, that looks cheap. But I took some additional research. I put in some assumptions. I tried to figure out what the market was really calculating and then made my estimates based on that to buy. Okay, so Anlims has a really good question. So Stephen Penman, he's author of Accounting for Value, very good book, very detailed, extremely intelligent person, and an excellent book. And he recommends that accounting earnings is a better indication of company performance than free cash flow. And there's that is why I use multiple methods. Instead of just limiting it to one, if you just limit it to one, what you do end up coming back to is, let me try to find that. Okay, what you do is you come back to this quality value growth. And if you just focus on one metric, you're going to fall into one area. But because I'm doing quality growth and value, I do believe that free cash flow is a strong indicator because these are companies that have plenty of ammunition to invest in other areas, to reinvest or to repurchase shares. And so it's a foundation of building company value. The accounting earnings side, which is also something that you can use for accrual analysis. It's a bit too detailed to get into, but there's another one called the Sloan ratio. And I showed that at the early at the beginning. Let me see. Okay, here. So when you build your action score, when you build your fundamental criteria, you can look up the Sloan accrual because that's based on accounting earnings, as well as looking at accounting fundamentals using gross profit to assets. So I'm not saying free cash flow is the best, but it is clearly very good compared to many out there. Even if there's negative free cash flow, I honestly don't want to invest in many companies that have negative free cash flow. Maybe you're okay with that, but I personally don't. So again, it comes down to what your criteria is, what your personality is, and what exactly you're looking for. So, John, are you worried about data mining based bias when you look at these historical performances? So that's why I had somebody, that's why George created that independent report, because he had the same concern. Am I overfitting? Am I trying to make the data fit what my assumption is and what I wanted to say? And I'm completely okay with that. But I spent over 1 year with a specific math PhD professor working on this formula to really fine tune it to making sure that it wasn't overfitted, that it wasn't based on just my biased on data mining. So I also and I'll share the link to the report with you as well, so you can see the full report. You can see it for yourself in full detail and really read through what the charts are saying and everything, uh, because um, if you do all the testing and regardless of how you put it, once the companies get into an A or a B, it does outperform the rest of the lower scores. Okay, Screener is updated every day based on the ending stock price. The every time a company comes up, every time they file a quarterly report, they're going to the screener will have it updated. But because price changes every day, and then there's a lot of ratios based on price, like price to free cash flow, that also gets updated. So you'll see constant changes and small updates. And yes, again, it's only for US companies, no European, no Canadian. It's just, I believe in just trying to get the best tool correct for the US market before I think about expanding to other markets. Just want to make sure the feature set, the quality, and all the scores and everything is the best it can be, because I've got a lot of money invested in my own portfolio. So I want to make sure that all the tools and the features is accurate and as efficient and as beneficial as possible. Okay, so Guild. Let's look up Guild. Guild. So it's a B. And it's showing that it's a mix of quality value score. It doesn't fall into any exact, it doesn't fall into, let's see again. Okay, it doesn't fall into any exact one because it's not skewed. It's a quality value. So this is so you're going to come across stocks where it's not going to match every single criteria or scenario. So these are broad ways, styles for you to identify stocks quickly and then to be able to filter down and get through that funnel, get through your process quickly. With Gilead Sciences, it's got the price has definitely gone down, quality, value, and growth. So, but then still at the growth stage, the reason why it's scoring a B is because remember how I said the Piotrowski is very important in eliminating junk. The way I've got it set up is that it's also an important weighting factor. A company with a high Piotrowski score, I give it extra weight. So if you look at a company and if you run a Piotrowski score and it comes up to like a 3 or 4, you know, you can look at it, but I don't want to waste my time with that. So that's why I've given it extra weight to the companies with a higher Piotrowski score. Gilead Sciences, they've got a score of 5, and compared to a company which could have a score of 7, 8, 9, that's why it doesn't get into the best range. That's why it's falling into a B. On the growth side, it has some really high growth over the past 5 years, but then over the past year, the growth has been slow. And again, it's not as efficient as they should be compared to what the size and the assets that they have. So this is why it's a B. It doesn't necessarily mean it's a value trap. Okay, it's not a value trap. It means it's right now you really have to, if you're going to do a Gilead, you should really look into whether this could turn into an A or a C. Okay, so whether the value will go down or the quality will go down, or maybe it could go up. So you really have to do your due diligence on this one if this was something that you wanted to look at. So one of the questions is, okay, have I done any rolling back test? So if somebody were to start a portfolio, say in quarter 1 and then rebalance every quarter, or if somebody wanted to join it in the half stage of the year, or a different time other than January 1. So that's something that I haven't done. It's actually in the process now. So that's why I have another member who runs his own fund, and that's one of the things that he wants to test as well. So he's going to be running those reports, those tests completely independently. He's not being paid by me. It was completely out of his own free will. So he's going to run that, and I'll share the results. But the reason why I chose a 1 year basis was because in a real life situation, I don't want to deal with constant churning of my portfolio. I also, based on what I've seen, is that a company can go down, but it also goes back up. So I'm going to give it a full 1 year for it to recover if it needs to. Because we saw that in 2016. Yeah, the market helped, but if you had sold out at the bottom thinking that there was going to be a big downturn, you would have lost a lot of money no matter what you did. Whether you used the action score, whether you used your own portfolio, it all comes down to just being more hands off, being more objective, having a systematic process, and trusting the process. I do know that finding value in the US is difficult, but I also say that there's a lot of opportunity because markets are they're never rational. There's always pockets of areas that are going to have areas of value, areas of quality, areas of growth, and areas where you can combine all three. So Canada, Europe, Asia, not at this time. It's just compared to where we are right now, I believe there's just so much more potential in the US market and what the tool can do for the US investors that I'm not expanding at the moment. Don't want to spread myself too thin. Just want to make sure that it's the best and it's proven for the US market first. Okay, so let's say you chose 20 stocks and after 1 month, a stock goes to a C. Remember my buy sell rules. So if I bought a portfolio and it was an A, and actually this is what happened last year. So I bought Calmain, and fundamentally the numbers were really good. It was coming off a great year, and I expected it to continue, even though it was going. I knew that it was cyclical, based on the fact that it had a real. It was one of the only companies to withstand the avian flu. So I bought it. It was an A, and then when it released its quarterly, and then the good years started rolling out, the scores started to drop. But I didn't sell out because you can either sell out if you think that you have better potential with an A's or an B's. But I don't sell out because I want to reduce my trading. I want to reduce the fees. I want to, if you can lock in taxes, then that's okay. But it also has the potential to go up. And I've seen in numerous cases where a stock went from an A to a B or to C, and then it went back up to a B and an A, recovered and did even better towards the end of the year. So that's why it all comes down to your own rules, what you're comfortable with. I just like the hands-off approach. I don't like to bother looking at my portfolio. I know my own behavior and my own biases. So that's why I have to push them down a lot of the times. Like I want to get in there and start meddling with it. But there's if you're familiar with Tobias Carlyle, the guy who wrote Deep Value, he's also greenbacked. He's also done a lot of testing as well, where he shows that human meddling will degrade performance if you just let it ride, and then just let it ride the bad times as well. It's going to do better than if somebody comes in and starts meddling with the companies. So here's an example of how I would go through a company. 4 steps. I'm looking to fish where the fish are. I want to decide rapidly, do some quick valuations, and then buy with confidence. So here's a 5-minute version of how I would actually go about doing this real quick process on a stock that I haven't even looked at yet. Okay. So this is just off the fly. I'm going to look at two cars. When I just reload, you get a fresh idea each time so that you get a constant, steady stream of ideas. I look at two counts, I look at the price chart, and it's gone above. It tells me based on a default DCF, the valuation is overvalued. But I've come to know that, okay, I'm not going to trust this because this is a 10-year chart. If you look at anything over 10 years, the graph is always going to look skewed. But if I zoom in to say like something like this, then that's more manageable. It's still done really well, but I'm not going to let the stock price determine and guide my thinking, because I'm just supposed to use the stock price as a tool, not a guide, not an indicator. Stock price doesn't mean anything. So what I do is I'll go into the OSV ratings, I'll look at this, I'll see that it has a quality, it's got a low value, and it's got a growth. So it has quality and growth. When you look at quality and growth, it's mostly a Munger type stock. Remember Charles Munger, he loves quality, but he also says buy a company at a fair price, and he's willing to not always be a stickler for getting the cheapest thing. So I look at this, I look at my OSV ratings. In the back of my mind, I know that the price has gone up, but I look at this, I go, okay, the value is D. That's probably going to make sense. The Piotrowski is a 7, and the Krowick is a 20%, and the free cash flow is 4.9%. So that's an area where I'm probably going to think, okay, oh, that's probably low compared to what Two Cows is, because I believe they're like an online company or IT company, right? Yeah, so they provide network access, domain names, internet services. So they're more like an internet-based IT company. So I'm trying to figure. I look at free cash flows and I wonder to myself, why is this so low? They should be much higher compared to what industry they should be in. If you look at other, let me load up. Oh, Red Hat. I've got Red Hat at the moment. This is another OS company. Obviously, much fatter margins, but they're able to convert $1 of sales into 27.2 cents in free cash flow. So that's the type of things that I'm looking at if I want a IT or tech company. So my indication at the moment so far initially is that this A quality score has the potential to turn into a B score if something doesn't really go well. On the value side, it's not surprising that it's a D compared to what the price is and what their free cash flow to sales is. The price of free cash flow is really low. EV to EBIT is outside my range, because I want it to be less than 11. That's my best range. Price to book, I'm not going to be concerned that much because it's an internet company, so I know the physical assets is not going to be as high. And on the growth stage, it's not that bad. Not that bad. Sales is positive. So B, I'm thinking that this could actually become either stay B or an A if it does a little bit better in the Piotrowski score and it improves fundamentally. Right now, Two Cows has quality value growth, but after a quick review of my step 2, what stock should I buy? Let's say it was Two Cows. Is this worth spending time on? I'm thinking that this quality would likely drop to a B and essentially become more like a growth company, like a Darling, where it's just a single growth score with a low quality and value. And so my process here would be to, okay, I'll probably skip this one. I'll look for something better. And then I'll go back to, which means I've passed up on the company here already, and that was within like 5 minutes talking through it. If I use the screener, I'm going to look at, let's say, another GARP stock, growth at a reasonable price. I look at AEO although it's an A, I immediately tell myself that it has a pretty good action score with a good quality, value, and growth. But because it's retail, and I have a big prejudice and bias towards retail, I'm not gonna go to it. But let me just quickly show you. Then do the valuation. It has that. I'm going to go into the valuation. And the different valuation models we use is the DCF, an earnings model, and an EBIT multiples. Based on the default is the earnings, but if I change it to the free cash flow, knowing nothing else and just only the current, if the company did consistently starting at this free cash flow, then you'll be undervalued. But again, remember, there's different components to a company. So if you look at the quality and the growth, will this go up or will this go down? That's what you have to think about. The Graham model shows that it's 23.47. And then if I do a EBIT multiples, where the conservative estimate is 7 times, normal estimate is 11 times, and aggressive estimate is 14 times EBIT, then this is the range I get. And so the final valuation I get is a valuation of 19. So on the valuation side, it's undervalued, but I still wouldn't invest in this because of what I'm seeing in the retail sector, in the retail industry. And I have a pretty good gut feeling, it could be wrong, but it's pretty good that the quality and the growth will go down. So getting back to the questions, don't want to hold up too much. Um, so we do have peer analysis. Um, I didn't go into all the features because I didn't want to take up too much of your time. But let's say I did Gap, GPS. Another retail company is what? Let's just try and go off the top of my head. Apple. Let's do Macy's. Um, Macy's. Okay, so based on this, you can do a peer analysis. I've got this is another visual way to compare and analyze as you get deeper into a stock once you've identified something. These are just some of my must-have categories that I like to look at. If you can have a visual approach to using just the OSV rating. If I want to look at, say, solvency related data points, then it will highlight the ones with the best numbers. On the valuation, now this isn't DCF or margin of safety, it's more like the ratios. So you can see what the best of breed is. So you use the stock database or the stock screener to identify what type of stocks you want to see. You can compare it in the competitor comparisons and then make your assumptions and adjustments in the valuation if you want to actively manage your portfolio. Make sure you go check it out. try.oldschoolvalue.com/OSV masterclass. Check out the page. We've got a lot of testimonials. We are consistently growing, and so this is going to be a fantastic way for you to leverage your time, condense those universe of 6,000 stocks into something much more manageable, where you're looking in a really good fishing spot, where you're looking at the really high quality companies and not getting bogged down in data overloaded with noise or information. So thank you again. I hope to do another webinar where I actually go through some more valuations and go through some live examples. So look out for that.